The Federal Reserve released their minutes yesterday. John Williams had comments this morning about the path for interest rate cuts, and we just got research out from the Dallas Fed that could tell us where the labor market break-evens are, and are we actually in a normal position? Are we going to expect more rate cuts over time? What's actually going on out there? Let's break down everything that we know right now. We're going to start by looking at the current expectation for world interest rate probabilities. We expect 1.78 cuts by the end of the year based on the market, and by my birthday, we'll get that second cut fully priced in, January 28th. And we're not looking for a third cut until next summer. So really, 2 cuts here at best, and then maybe third cut by next summer. That's current market pricing. And a lot of this is on the backs of the Fed being a lot more neutral than dovish. Even though Jerome Powell told us that we're currently running below break-even employment, he's broadly been very neutral. Like, he hasn't been a dove, he hasn't been a hawk, he's been relatively neutral. And part of this is because of people's inflation psychology. See, remember the story that I give of when I go to the AT&T store and the guy's like, oh, I just bought a house. I guess with inflation above 2%, I don't understand why the Fed's talking about cutting rates. People don't know about the labor market. They don't understand break-evens. They don't care about any of that crap. All they hear is, what? They're lowering rates and inflation's not yet at target? That's weird. What? That's all they hear. And the risk there is that inflation expectations run away. And this is exactly what Fed Williams warns. But he actually gives us a really clear breakdown of what to anticipate when it comes to rate cuts in the long term. And this is something that's actually really, really bullish. House hack, because you're going to get a long-term expectation in just a moment. I'll break it down. I'll explain. If you haven't seen the house hack update video and the reinvest update, go watch that. It's on the channel, Meet Kevin under the live tab. But anyway, let's first, before we hit Williams's long-term forecast, let's understand what the Federal Reserve Bank of Dallas just released. They released this today, October 9th. Recent employment figures, they basically talk about the break-evens. And they talk about how labor break-evens used to be around 250,000 because in 2023, we had data showing us that our population was exploding. The growth rates of our population were massive, well over 1.25% to 1.5%. And so very, very large moves here in an expanding population. Part of it because, you've got 400,000 Venezuelans who get temporary protective status under Joe Biden. You get hundreds of thousands of Ukrainians who are given asylum in the United States. You get an open border, basically, between the United States and Mexico. So you've got this explosion of population coming in. Mind you, there is some benefit to a population coming in. I mean, The Economist yesterday had a fantastic piece where they talked about, hey, immigration generally reduces your net per capita GDP. Like, it usually helps. It usually doesn't hurt. We're not generally taking from Americans. We're generally growing. So The Economist thinks longer term, there are some real problems about not having a better immigration system like illegal immigration. Nobody's advocating for illegal immigration. But the Dallas Fed guy, this economist, he basically tells us, bottom line, that he thinks we're sitting at about 30,000 as a break-even labor market report. And current estimates are that we probably over the last 4 months have had a break even or an employment reads roughly at break even. So it's no surprise the unemployment rate isn't changing because jobs are being added at roughly a level that's equal to the expectation of the break even rate. Now, this, in addition to an aging population, has this economist suggesting that the labor force participation rate is likely to continue to trend down. And as it continues to trend down, you actually end up subtracting from the break-even rate even more. And that's how he ends up getting to this 30,000 break-even rate. Gosh, Donald Trump just posted 18 freaking times on Truth Social. It's like the most annoying thing ever when you have notifications on for it. And 27 of these are just pictures of him. Something about like all these stats people were spamming. I always think it's funny though. It's like, man, it's like I feel compelled to have notifications on for it, but man, that's spammy. Like a lot of people use the Meet Kevin app, which is free, to get notifications on my videos, but I tried. Like, I don't want people to get spammed with notifications. Like when we send a trade alert to people in the course member live stream, like, I'm buying this stock for the next 10 years or whatever, and I send that notification out, like, I want people to, like, get the notification, not get spammed. Come on, Trump. It's just like, as I'm filming this, it's like, boom, 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 boom. Like, oh, man. But anyway, so the break-even rate's 30,000. Is what he's arguing. And part of that is because of the cooling participation rate. Now be careful, because if the participation rate starts rising, the unemployment rate will skyrocket. If layoffs start rising, the unemployment rate will skyrocket. He's not capturing that in his break-evens. Both of those things could ruin what this guy is saying. So be careful with this. Mind you also, the level of 27 weeks unemployed workers is a sign of labor market weakness. When you zoom out over 10 years, obviously post-COVID, that level was a lot higher because people lost their jobs in COVID or just stayed out of the labor force. But this level has been steadily rising, which is generally a leading indicator of recession. So even though this economist is telling us, hey, we're good at 30,000, we still have leading indicators of recession that tell us, hey, there are underlying weaknesses. Not only long-term unemployed going up, that's one. Number two, if layoffs normalize, we're screwed. And if the labor force participation rate goes up again, we're screwed. All of those things can really screw all of this economic analysis on the break-even rate of employment. But what the break-even rate of employment does, and what this research does right now, is it says rates are probably going to stay higher for longer, for the near term. We're not going to get frantic cuts until we get a serious normalization in layoffs or that participation rate. Because they're basically going to justify a slow rate cutting regime until those numbers change. This is the Federal Reserve justifying why we're going to go slow. And part of it has to do with inflation, which is where the Williams part comes up. Now, in the Fed minutes, the Fed was nervous about cutting because of inflation that's obviously above 2%. Expectations are that inflation is going to trend towards and maybe bob around 3%, basically. And this has a lot of people wondering, like, why is the Fed cutting when inflation is 3%? This is insane. And Williams actually makes a really good argument. He tells everybody to make sure to sign up for the Meet Kevin membership using coupon code Schumer Siesta. You get all the trade alerts, the new lectures coming out probably this weekend, all 8 courses, the Alpha Report every single morning. We called the Qs yesterday. We had some great calls. We actually had a great momentum trade yesterday as well. Some great calls today. I think the Alpha Report, you have to see it to believe it. Consider joining it, but it's pretty amazing. Knock on wood, can't always be right, but we've had a great precedent here. So thank you for all those of you part of the membership at meetkevin.com. But anyway, what Williams tells us is really interesting. Is I want you to set this up for a moment. So near term, the Fed's worried about inflation. They're going to signal they're worried about inflation, and they're going to justify or rationalize why the labor market is doing what it's doing, right? Like, write these things down for a moment. And I think there's a value to this so you could see a little bit more clearly what's going on with the Fed here, okay? So what are they doing? They are rationalizing low break-evens, okay? That means rates higher for longer, for now, right? In addition to rationalizing lower break-evens, what are they doing? They're signaling fear over 3% inflation hitting psychology. Rates higher for longer, right? Then we still have no layoff normalization or increase in the participation rate, which also implies rates higher for longer, okay? That said, okay, we know long-term unemployment rising is a harbinger of bad news, okay? It's a leading indicator. Now, what ends up happening when unemployment gets worse? When layoffs and participation normalize, the Fed knows they can rapidly cut. And take a look at literally what we have here, what Williams says. Williams says that as the unemployment rate, I can't remember exactly where it was, Fed's credibility. We need to, stay credible with inflation. We need to do it in a way that minimizes the labor market cooling more. It's somewhat a way of saying like, hey, we've got to be aggressive on inflation. Williams is saying we got to be aggressive on inflation, but we also don't want to screw up the labor market because there are some underlying issues. So we think there's more downside risk to the labor market employment, and that's something that takes some of the upside risk off of inflation. Okay, why is that critical? Okay, because when SH9T hits the fan, as Williams implies here, what happens? Deflation. The inflation problem will evaporate suddenly when the job deterioration hits. But for now, in the near term, like probably next, 3 to 6 months, hard to say rates are going to plummet. Next few years, almost certainly a plummet is being forecast by the long-term unemployed and distortions in the beverage curve. You already know it, beverage curve, whatever you want to call it, right? So this is huge. This is really big, and it's really important to understand that because it tells you near-term pain for bonds, but long-term, the direction is clear. The Fed wants to lower rates because they see the weakening in the labor market. They just can't right now because of the stubbornness in inflation, and tariffs definitely contributed to that pain. So anyway, check out the Meet Kevin Alpha Report. Would love to have you over there. It's coupon code Schumer Siesta. And yeah.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.